Welcome to the weekend, everybody. It's finally here after a long wait, 4 years to be exact. The rate cut we've all been wishing would happen has happened, and it was a big one. Welcome to Wealthion's weekly market recap. I'm your host, Andrew Brill. Let's see what our experts had to say this week. Global liquidity expert Michael Howell joined us this week and expressed his feeling about the Fed's concern over the U.S. debt and the slowing economy. He said the U.S. debt, on top of debt, is leading to raising liquidity levels and what might be the next black swan event.
So why don't we spend a few minutes talking about China, because it is the second largest economy in the world, representing 20% of global GDP. And as you mentioned, there is a massive slowdown there. We really never know what's really going on in China, but maybe you can give us some sense of how bad things are in China and how it's impacting the rest of the world.
Well, I think what you've got to do in terms of analysing China is to sort of split out the secular, the trend, from the cycle. And as I said, if you look at the cycle has really been affected adversely by a tight monetary policy. And that tight monetary policy has really rested on the fact that China has had a goal, which is maintaining a firm or at least stable yuan against the US dollar. And that really goes back to their maybe longer term ambitions of trying to create a rival for the US currency, certainly within the Asian region, maybe even ultimately globally. And what they perceive is that they can actually extract a lot of soft power, if you like, by having a robust currency. So that's been one of their geopolitical goals, if you like. And therefore, as the US dollar has strengthened over the course of the last 2 to 3 years, what you've seen is the Chinese really struggle to maintain the value of the yuan, and therefore they've had to tighten monetary policy. Now, the reason that's significant is that all economies were hit, as we know, 2 to 3 years ago by the COVID emergency. And the West came out of that accomplished by a very easy fiscal and monetary policy. And in fact, so much so that we know we've got this short-term legacy of inflation that policymakers are currently fighting. But China didn't really have that luxury. And what China faced as it was trying to come out of COVID was this tight monetary policy that was put in place by the People's Bank to try and maintain this firm yuan against the US dollar. So they've never really had the opportunity of really a recovery from COVID. The economy has been in the doldrums for some time. That's the cycle. Now, that cycle can be reversed as soon as they start to throw monetary policy or ease monetary policy back in, onto the economy. The secular is a very different question. And I think what China is really seeing now is something that is called by economists the middle income trap. And that really means that you get up to a certain level of income per head and you just find it very, very difficult to actually grow anymore. The easy growth is there. And the more difficult growth, where you've got to actually incentivize the consumer, you've got to get deeper productivity gains, you've got to invest in new technologies, etc., is actually very hard to come by. Now, the problem that China has had, or still has in fact, is that the consumer is not really enfranchised in China. So if you look at Western economies, clearly they're driven to a very, very large extent by consumer spending. That is not the case in China. Consumer spending is important, but it's not the same share of GDP that you see in Europe or the States. And that's something that the Chinese ultimately will have to remedy. That means that their economic growth really depends on two features. One is more and more capital spending, or particularly infrastructure spending. And the problem here is that you can't just keep building bridges or roads to nowhere. They're very unproductive. They create a lot of debt. They saddle the economy with interest expense, and ultimately it's a drag on economic growth. And the other dimension is export growth. Now, if you've got tariffs and trade protectionism emerging, it's very difficult for China to actually maintain market share and actually grow its exports. So you can see the problems that China is facing both cyclically and secularly. And those two problems are significant, and they're basically causing China a lot of grief right now. That have to be addressed. China is a big economy. This matters not just for China, it matters for the world. But we're really searching for some sort of solution. And I think my ultimate answer is that the current model of red capitalism, if you like, just doesn't work.
So the consumer in the U.S. economy represents approximately 70% of GDP. What would it be in China?
No, nearer 50%.
Right. And it's interesting you brought that up because a couple of high-end retailers, LVHM and also Gucci, have both said their sales within China are down significantly. I think it was around 50%. So the consumer there is definitely feeling some pain. And I believe LVHM also said their champagne sales were down 50% because people there have nothing to celebrate.
Yeah, absolutely right. Yeah. They can't even drown their sorrows.
So let me try to unpack what you said there. So first of all, the message that the Fed has been sending out for many months now is that they are hyper focused on inflation. They want to get inflation down from the high of 9% down to their target rate of 2%. But you're saying with this last speech that Powell made in Jackson Hole that he is now saying he's still focused on inflation, but it sounds like they're very concerned about what's happening within the economy and the growth and the slowdown that we're seeing in the economy. Do I have that right?
You have that absolutely spot on, but I'll also add another dimension, which is the fact that also financial stability is a key criteria, and that financial stability extends to the treasury market and the ability of the government to fund itself. So we've got to look at these dimensions too.
And so what were you saying, that you think the Fed is concerned about what's happening, even though they're not saying?
In the economy?
Yeah.
Yeah, I think they are, for sure.
Like are they more concerned about the inflation rate or about the economy slowing down?
No, I think they're more concerned by the economy slowing down. I think they're not sure they've got a handle on it, in my view.
Right. Even though, yeah, okay, that's good, because even though they don't communicate that.
Well, I think Powell's last speech was sufficiently sort of nervous about the economy that it suggested there was some hint of panic.
So do you think the Fed sees a potential problem on the horizon, and that's why they made these changes?
I think they see I think they recognize there's a problem in terms of funding in the medium term for the US public sector. Absolutely, because there is a big problem, and you just got to look at what the Congressional Budget Office is projecting for the future debt GDP ratio in America. I mean, there's an underlying fast rising secular trend in mandatory spending that somehow has to be funded. And the CBO are very explicit about this as being a major problem in the medium term. So there's a lot of debt financing to do. And I think the Federal Reserve and the Treasury together, because of their activities, their joint activities, in what I was saying, if you like, actively duration managing the calendar, they're very concerned about this. So I think this is a background point, but it's an important point. Regarding the economy, I think Jay Powell flagged growing concerns among the FOMC about the integrity of the economy. I don't think the economy is in recession. I don't think it's near recession, but I think the Federal Reserve maybe is hinting here that it's uncertain about the medium term, whether it has control over the economy. And what they clearly want is to put some support in my view. So this is perhaps a cushion or a safety net underneath the economy. And therefore, cutting interest rates now and read that as adding more liquidity, which is the key factor, is really what they're up to. I mean, at the end of the day, the Federal Reserve, despite the market's focus on monthly CPI numbers, Federal Reserve is really looking at what the fixed income markets are saying in terms of longer term break-even inflation. That's really the key. This is the whole sort of, if you like, framework that the Federal Reserve put in place for inflation fighting. And what that's telling them is inflation is beaten.
So you touched on debt, and the federal debt now stands at $35 trillion. Mind-blowing number, and it's growing by $1 trillion every 100 days. Interest expense on that is $1 trillion annually. So are you saying that the Fed is very concerned about potential interest rates when they go to refinance this debt? It's going to be costing a whole lot more?
Correct. I mean, that's got to be a worry because, you can now see, I mean, just by the math of this, is that if interest rates go up, debt service costs go up, which means more debt. And what you're doing is you're piling debt on top of debt. And this is not a great situation to be in. So if you look at the debt GDP ratio of the US as projected by the Congressional Budget Office, it looks like an exponential curve upwards. I mean, these are not healthy situations. We've got too much debt. This is the problem. But the reality is that one of the things that people have got to recognize is that debt goes hand in hand with liquidity. And we're in a situation now where financial markets have moved very clearly away from being new capital raising mechanisms into being basically debt refinancing mechanisms. And that's a very important, subtle, but very important difference. Now, what that basically means is that liquidity is needed to roll over debt. And, the reality which people forget is that, if I issue a 5-year bond today, that may be great for 5 years, but in 5 years' time, I've got to refinance that bond. And to refinance, you need balance sheet capacity, which is really liquidity in the markets. So you definitely have to have, with rising debt levels, rising liquidity levels. Now, the reality is that liquidity spills out. For the last decade or 2 decades, most of that overspill of liquidity has gone into other financial assets. In the last 2 years, it was so significant that it spilled over into the high street, and so you got consumer price inflation as well. But what we're looking at is debt, which is growing at something like 2 to 3 percentage points faster than US GDP, which basically means that you're looking at something like, 8% per annum growth in debt, which means you're getting 8% growth in liquidity. And that is the sort of benchmark or hurdle you've got to think about in terms of your asset market returns, because liquidity drives those asset market returns. And so you need assets that will keep pace with monetary inflation. Gold has shown us for centuries that's what it does. It may lead and lag a bit, but generally the trend is there. High quality equities seem to do that. That's what experience shows. Fixed income markets do not do that. Prime residential real estate does that. And for the last 5 years, Bitcoin has done that.
Michael, you have said in the past that all financial disasters are brought on by an inability to refinance debt. Do you see that happening in the coming months? And I guess also what I'm asking here, do you see a potential black swan on the horizon, and that is an inability to refinance debt?
Well, I think the sort of glib answer is yes, but I don't know when, because the fact is that what you've seen historically, and you go back through history, and you go back particularly in the last 2 decades, what you find is that every financial crisis has largely been a refinancing crisis. Think of 2008. Think of the Asian financial crisis in '97. Think of what happened in the US repo markets in 2019. All these are instances where refinancing becomes a problem. I mean, arguably even Silicon Valley Bank was a refinancing crisis. And what it comes down to is if we've got so much debt, we're sitting on so much debt, that debt is a burden, that's a cost. That debt has to be refinanced. And if that mountain of debt just keeps growing, the refinancing challenges obviously grow with it. And what you need is more and more liquidity to keep pace. Now, liquidity, as we've argued, is cyclical. And therefore, if you get at a time when you need a lot of refinancing capacity, liquidity turning down, then you've got a problem. And in that environment, you either get debt defaults, people tend to fire sale assets so they can refinance in other areas, etc. And that's where the tensions emerge. So it may be a glib comment, but yes, we will get that, because at the end of the day, liquidity is cyclical. And it's very, we can't depend on monetary authorities to manage things perfectly. So I think it's going to come. Is it going to come in the next 12 months? I think that's very unlikely, because I think if you look at the debt wall, the debt wall is probably about 18 months to 2 years away. That's when a lot of debt has to be refinanced in the world economy, or the US economy in particular. And I think we've got a window now where there's not that much, so it should be manageable. And from what I've argued, liquidity is picking up. Therefore, there should be few problems. I think the question really comes is when you get an inflection in that global liquidity cycle, which if you go back to the first chart I showed, our reckoning is that comes sometime towards the end of 2025. And that might be because inflation begins to pick up again. It may be because the world real economy starts to get more traction and financial markets suffer. Could even be because the Federal Reserve thinks it's made a mistake and wants to push rates up again.
Economist E.J. Antoni explained why rate cuts alone are not going to fix anything and what is left of the federal budget after mandatory spending. He explained how a post-pandemic reality is misleading the employment numbers that are a key driver of rate cuts. He also touched on personal debt via credit cards and how energy exports could be the key to stabilizing the dollar and revitalizing the economy. What federal budget? It seems like all we do is spend money.
I would say that's a pretty accurate assessment. What federal budget? That's a good question. We don't have a federal budget. We haven't for years. The Republicans in the House promised we were going to get our 12 appropriation bills. Here we are. We still don't have them. And it doesn't look like we're going to have them anytime soon. It looks like we're just going to get, another CR, another continuing resolution. So things haven't really changed much, unfortunately. That's particularly troubling given the data that we just got from the Treasury Department. They released their monthly Treasury statement for the month of August. It was the worst deficit we have ever seen for the month of August ever. And that includes the two blowout spending years, 2020 and 2021, when we had all those literally trillions of dollars in excess spending that was allegedly related to the COVID pandemic. So, unfortunately, things are getting worse, not better. We've already hit a $1.9 trillion deficit for the current fiscal year. And for those, playing along at home, the current fiscal year doesn't end yet. It includes the current month of September. So we still have a month to go, and we've already blown past Treasury's deficit projections from earlier in the year. So yes, we'll hit $2 trillion in deficit yet again, without question. It's not good. This Treasury statement actually had a lot of other rather ignominious firsts, not the least of which was interest on the debt has now cost over $1 trillion for this fiscal year. And again, the fiscal year isn't even done yet. So all of those folks who earlier in the year said, this $1 trillion on the debt, interest on the debt, that's pie in the sky. It'll never happen. Oh, no, it did happen. And again, it's getting worse. The fiscal year isn't even done yet. So it's a huge, huge problem. The fact that we just keep stringing together these more or less random bloated spending bills without actually having, as you said, any kind of federal budget put together.
Why don't we regulate credit card interest? I mean, 30%, EJ, is that's absurd to me. I think I remember when I got a credit card, it was 12%, was like, pay off your bill or you're going to pay 12% interest. Now, there's no way to get ahead of this. If you've fallen behind and you have credit, it takes you 20, 30 years just to make the minimum payment to pay off that debt. And if you need money, obviously you're going back to the credit card. Why don't we regulate these things?
In short, Joe Biden, he was the senator from Delaware and was effectively a lobbyist for credit card companies for a couple of decades, and got a lot of the not just simply removal of regulations, which I'll touch on in a minute, but actually got preferential treatment for the credit card companies, where they actually have essentially protections under the law, which other types of creditors don't. Now, going back to the regulation side, I think it's important to note that credit card debt is not like a lot of other debts insofar as, while well, let me put it this way. You don't have the same kind of collateral on that debt as you do for others. In other words, if you don't pay your car loan, what happens? Well, the creditor can take that car from you, right? They can repossess the vehicle, and then they have an asset now which they can sell to try to recoup some or all of their losses on your loan. You don't have that with credit card debt. It is an unsecured loan. In other words, I can, for example, I can go out and simply rack up credit card debt eating at restaurants. What asset are you going to collect on as the creditor? I mean, my stored up fat? I don't know. So as a consequence of that, when the credit card company finds your loan non-performing, in other words, you're behind on your payments, you're not making payments, they have to sell that debt to a debt collection agency, and it very typically sells for somewhere between 5 and 12 cents on the dollar. In other words, they'll lose like 90% of the money they gave you. And so they have to make up for that somehow. And the way they do that is by charging what appear to be extortionate interest rates. So the fact that the rates are so high today speaks not only to the fact that there are other alternative uses for that money, which pay a high interest rate. So for example, instead of a very risky loan to a consumer at 30%, they can have a zero risk loan to the Treasury at over 5% using things like T-bills. So there's not only that dynamic, right, that the alternatives are going up in interest rates, in return, I should say. So you need a higher return on credit cards. But on top of that, the rate of loan non-performance, again, defaults and delinquencies on credit cards is rising at the fastest pace since the global financial crisis. Now, that's not to say that the levels themselves are the same. In other words, we're going from, let's say, 1% to 5%. And before we went from 15% to 19%. So the levels are not the same, but the rate of increase is the same. And that's particularly scary because it points to where we're likely going in the future. So in other words, as credit card companies anticipate more and more people not paying back their debt, they're hiking the interest rates in order to try to recoup those losses.
We've heard a lot about, the jobs that are being created, or the jobs that are where people are getting hired, are part-time jobs. And it occurred to me that, is the new norm changing? Are we going to, the pandemic, everybody was working from home. Everybody wanted to work 2 or 3 days a week. We kind of got used to a little bit more freedom, not being in an office and all that. Is the norm, in your research, are you finding that the norm is changing? That the regular full-time job that used to be there isn't there anymore? And let's face it, you know what? A full-time employee, benefits are expensive. Other perks are expensive. So if you can hire a part-time employee that, or 2 part-time employees and don't have to pay out those benefits, obviously the dynamic changes. Is our new norm changing?
I think you're spot on. Absolutely. The post-pandemic economy is radically different in certain ways than in 2019. And actually, this is why I have a lot of sympathy for the bean counters at the Bureau of Labor Statistics. They are dealing with a lot right now, with a lot of problems. And their models and methodologies that they relied on for a very long time and had a proven track record, all of a sudden are failing them. So that's where I have a lot of sympathy. Now, where my sympathy goes away is the fact that these problems were evident in the spring of 2022. Here we are 2 years later, more than 2 years later, and nothing has been done to fix them. So now we're going from, I guess you could say, ignorance to willful ignorance, right? And I will say this, the reasons behind why workers are behaving differently, those reasons have also changed. So during the pandemic, people didn't want to work as many hours. People wanted flexibility of things like being able to work from home. And today, the reason why people are changing work or getting additional work or getting another part-time job is simply because they can't make ends meet. It's because we're in a cost of living crisis. And this is part of the reason why the growth in non-farm payrolls, that's the jobs report that we get every month, right? When you hear those headlines, 100,000 jobs added, those are non-farm payrolls. One of the key reasons why that has been exploding the last several years is so many people who already have a job having to get a second job or a third job because they can't make ends meet. And the consequence of that is every time a business adds another payroll, even if it's a part-time one, doesn't have to be a full-time one, it gets counted as another job in those monthly reports. And again, the 40-hour-a-week job and the 20-hour-a-week job count exactly the same there. So it's not as if, well, let me give an example, I think. If I lose my full-time job working 40 hours a week and I get 2 part-time jobs, I now go from being counted as 1 job to 2. I get double counted. Conversely, in the survey of households, that's also part of that monthly jobs report, I still am only counted as a single person employed. And this helps explain the unprecedented divergence between those 2 surveys that we've seen the last several years, where the level of employment has been flat and actually since November has been going down, whereas the number of non-farm payrolls, the number of jobs, continues marching steadily higher. We are seeing fewer people employed, not more. We are seeing more people having to work multiple jobs. We're also seeing people lose their full-time jobs and replace them with multiple part-time ones. And at first glance, you may think, well, what does it matter if I lose a 40-hour-a-week job and I have to take 2 20-hour-a-week jobs? Isn't that kind of a wash if the pay is the same? No, because of something you mentioned already, which is benefits. And what we're seeing today right now is a lot of businesses letting go full-time workers and replacing them with part-time ones because they can't afford benefits anymore. We forget that inflation doesn't just hurt the consumer, it hurts firms as well. And sure enough, if we look at the data from the Bureau of Labor Statistics, where they provide a price index for not only consumers, but for businesses as well, the CPI and the PPI respectively, what we find is that they are both up almost exactly the same, right about 20% since January of 2021. In other words, all of the cost increases that you are seeing right now. So let's say you go to the grocery store and you grab a dozen eggs or 18 eggs, whatever it is. I go to Costco, so it's like 72 at a time. You buy your carton of eggs and they're up 50% in less than 4 years. It's insane. But what we forget is that the store owner is also paying 50% more for those eggs. And that's why when we look at things like corporate profits, the profit margins really haven't budged. So even though the nominal profits have gone through the roof, you adjust for inflation and you find out they haven't. In the same way that the typical American family has a paycheck which has never been larger, that's a fact. Nominal pay has never been higher than it is today, on average. I know for some people it's not, but on average. However, adjust for inflation, and those larger paychecks right now buy less than they did 4 years ago. Corporate profits are exactly the same. Again, just within the last couple of weeks, we got data for retailers, we got data for manufacturers, all official data from the government. This isn't my numbers I'm making up. The official government data show that those businesses' profits are down in real terms. Adjusted for inflation, they have fallen. So, kind of circling back here, I think that it's really, really important to remember that while things may look very rosy on the surface, while the aggregate numbers are growing, that does not represent the reality that people, whether it's a business owner or a consumer, that people are feeling.
So if we were able to create energy, fracking, use natural gas to make all the things that you were talking about, can we export that? Because that would increase the value of the dollar.
We certainly could export it, absolutely. But one of the things right now that is hampering exports, because believe it or not, we're actually drilling and mining like crazy right now in this country in order to meet global demand, when you have a lot of places around the world like Europe that have basically just shut off the taps to all their own energy. That's why, for example, Russia is now importing more energy to the EU than ever before, despite all the sanctions. I mean, the crazy thing is all those sanctions are doing is bankrupting our so-called European allies. But if we actually get rid of all the red tape that has been put on American energy exports over the last 3 years or so, you would have an energy export boom. You would see the tankers for LNG, for example, shipping out from the Gulf and from the East Coast and heading over to Europe and other places around the world too, quite frankly.
And that would give a huge boost to our economy, wouldn't it?
It certainly would, and not just in terms of the official data. I mean, obviously, it would increase what we call net exports, so that would add to GDP. But also, the other thing it does is, and this goes back to what you said with strengthening the dollar, is it gives people something to actually buy with our currency, and that's been a big problem for literally decades. People were essentially taking our currency and holding it as the reserve currency of the world. That's all beginning to unwind. A lot of that has to do with how we have mishandled the situation in the Ukraine and the very terrible steps that we have taken there with confiscating dollar reserves, for example, taking money that wasn't even ours. So however you feel about that conflict, it was a terrible monetary move. And one of the effects of that has been people deciding to dump the dollar, whether for Forex or for international exchange. The consequence here is that as the position of the dollar, as the world's reserve currency unwinds, we need to find uses for people's dollars. And if we don't, we are going to have 70 years worth of deficits come pouring back to this country. That's when you'll see a real inflation.
Right after the rate cut, Vincent Deluard joined us live on Wealthion to talk about the half-point rate cut. He's wondering what the Fed is concerned over to drop the rate that much. He also talked about the risk of hyperinflation, how bad it could be, and where the stock market will head after this large cut.
Does this tell us, so when the Fed does something aggressive like this, we often think, do they know something we don't? Should we think that perhaps the Fed is worried about something in the system, or is growth slowing to the degree, is a recession knocking at the door, that the Fed would be worried enough to go 50? Is that how we should read this?
I mean, I would read it as the Fed is worried that it, should have cut in in July, didn't do it, and now it's trying to make up the lost ground, and so that they don't look too bad. I think the recession is, where, you look at Atlanta Fed GDP now, it's at 3%. Housing starts are really good today. Unemployment rate ticked down in the last report. Hours worked increased. I would have many questions for Jay Powell if I were in that room. Like, what does he see that makes him think that we need, 50 basis points? I mean, we could very well have gone, 25 and increase the speed if need be, but it seems like, why front load it so much?
Yeah. So do you think that there's very important to dig beneath some of the narratives here, right? And so do you think that the economy is slowing enough to face a recession? If not, why not? What are the things that you see that indicate the Fed should be a little bit more conservative here?
Well, so in general, I think we have this massive issue with statistics. It started before COVID, but it got worse with COVID, quality of statistics. And we've seen that all these revisions, all these adjustments, very low response rate. So since that happened, I spent a lot more time looking at the daily treasury statement, which measures the cash coming in and out of the treasury general account, and specifically looking at tax collections. Because I believe this is, tax collection, everybody pays taxes. We all hate to do so. So no one pays more than they should. And we can see that on a daily basis in the US. At this point, for the year, tax collections are up 9% from last year. And there hasn't been a change in tax law. So I don't think there's been any case in history where you've had people paying 9% more in taxes and the economy falling into recession quite immediately. And if we look at the more recent trend, and of course there's some volatility, right? I mean, some of the tax collection, you get more money at the end of the month, beginning, whatever. But adjusting for that, there is no sign of a slowdown. So that's what gives me confidence that the economy is not slowing. And then again, because there is so much uncertainty about the Fed's the BLS release, I look at anecdotal stuff, because at the end of the day, I mean, the world is just, a lot of anecdotes tied together. You look at TSA crossing, how many people are flying across the country, record high, 10% higher than last year. You look at restaurant bookings, you look at Red Book Index of retail sales, you look at concert attendance, all these kind of anecdotal stuff points to an economy that's doing just fine. So I legitimately do not know what the Fed is seeing other than this massive pressure. Basically the market's been, in my opinion, almost bullying the Fed into cutting by 50. And, contrary to prior instances where it happened, the Fed seems to have, given in.
Yeah. So if we look at, and I want to dig into a little bit more about sort of, what people should be thinking about when it comes to this, and maybe some of the sort of narratives to challenge that we hear out there. But when we look at the reaction, stocks are rallying. So if there's no recession and the Fed's now, lowered interest rates, positive for risk assets, positive for U.S. equities.
Yeah, of course. I mean, buy degens, buy,
Degens, degenerates, like everybody.
We have 3% inflation and, 6% nominal, 3% real growth, and the Fed is cutting by 50. I mean, of course, buy everything, guys. I mean, it's the Fed put, but with a strike price that's like way above anything that made sense before. And I would also look at gold. I mean, gold, gold is at what, 2,600 on the day? Yeah, it's almost got to 2,600. We have the Fed cutting by 50 bips when the market is an all-time high, and the unemployment rate is basically at a 50-year low, and inflation is 1.5% above target. So yeah, I would definitely be a buyer of anything that represents a real claim against the economy, because this is very positive for nominal growth, I would guess.
So, because there are people who are looking, we've been coming into this thinking, we saw the wobbles. Now we're sitting near record highs again for equities, but we saw those wobbles in the summer. There's been so much talk about the AI bubble bursting
Right.
and people needing to get more conservative. There's so much volatility. We're, seasonally in a tough time for markets, but this seems like it just opened the gates for the bulls.
Yeah. I mean, there's only 12 days left in September, right? So better get that bear market going soon.
Well, with this as a backdrop, it doesn't seem like it. So, okay, maybe for those who were worried about their equity position, this is good news. What about if it is the case, we're looking at treasury yields look like they're rising a little bit. What does that mean for bonds? If it's good for stocks, is it bad for bonds?
I mean, I think it argues for steeper curves, right? I mean, you're gonna cut the short end more than people thought, and then I think the long end needs to start pricing this kind of hyper reactive Fed and the risk that growth and especially inflation increase. So if you were to think like the cuts were going to come later and then you kind of front load them, it makes sense for the curve to be steeper and yes, the long end to the long rates to increase on the day. I mean, is that what has been going on today? Let me check.
It looks like listen, we're all getting this. Like you look on your.
I'm looking on my Bloomberg right now.
Yeah, because
where are we?
Things are going to move quickly. So
okay, no, it fell on the news and then bounced back. No, it's still at like 3.6, something like that. I mean, which is still, if you think about it, an insanely low level for the 10-year, when again you have real GDP growth of 3% for 4 quarters now. Inflation still, some segments of inflation reaccelerating if you get shelter, if you get core services, and you have a very easy Fed and the chance that fiscal policy becomes even more accommodative after the election.
Yeah.
So I mean, I would be max bearish on duration at this point.
Is there a risk of hyperinflation? So I know you've been concerned about inflation, and in your report you talk about some things that you see as an indication that we haven't tamed inflation. Because if the Fed's cutting 50, they're basically saying like we won the fight against inflation, right? But not so fast. Is that a risk that we could see a return to inflation? Maybe not hyperinflation.
Yeah, I mean hyperinflation. So there's I recommend you guys. Steve Hunker, I think, is the economist that's a specialist, and he has this amazing table of case of hyper. So he has this hyperinflation is something that has a clear definition. I think it's a monthly rate of inflation of about 50% for more than 28 days. Yeah. So we're talking like I'm not even sure that Venezuela qualifies here.
Yeah, this is an extreme.
We're talking like Zimbabwe or Weimar Republic or Hungary in 1946. So I am not forecasting.
To be clear,
I mean, price doubling.
You are comfortable saying that you're a bit of an inflationista.
Yes. No, what I see happening is a reset of inflation to 4 by, and I would argue we're already there. That was the point of my little haircut story. It's been 4 years now that we've had, hairdressers making 4 or 5, or at least, I don't know if the hairdressers are making more, but certainly the cost of a haircut has been going up for 4.5%, 5% for 4 years now. If you look at more services, we already live in that world. I mean, the last sub 2% print was February of 2021.
And that's services. And when he's talking about services, and this is why the haircutters are great, we're having some fun with it, but it is really important because a lot of our economy is based on services. And anecdotally, all of us know that. If you've gone out to eat, if you've tried to travel, all of the things that we do fall into the services category. And so while manufacturing has been weak, and you and many others have pointed this out, we have sort of dual economy, services have held up and been strong. You're also looking at shelter, which is important in CPI. You had a chart, I think we can pull up in your research. Why is that something we need to be paying attention to? And you're going to hear, owner equivalent rent, all these sort of fancy terms, but why does shelter matter? And what are you seeing there that worries you when it comes to inflation?
I mean, the weights, right? I mean, it's a 30% item in the CPI, shelter. So, if you're significantly above 2% on shelter, it's going to be very hard to make that up with other categories, especially when your core services ex shelter are at 4-5%, right? So you need intense deflation in goods and commodity prices to make up for that. Now, shelter is important because shelter was the crux of the argument of the deflationist recessionists, was that the way the Fed measures shelter costs out of the BLS and then feeds into the Fed is lagged, right? They have this survey where you ask people, how much do you think you would rent your house for? And then the panel of rents that they use rolls over slowly. So you're lagging. And the idea was that the Fed started hiking 2 years ago. We had a fall in, actually, didn't really have a fall in rent, disinflation in rent. So that's going to feed through the data, and we're going to see lower shelter prints. So we need to look at inflation ex shelter. And if you did that for a couple of months, you could see that we were below 2% ex shelter. Now, this relied on the premise that shelter was going to drop from that plateau of 4-5% it's been stuck at for many years now to something like 2%. And we saw that in June. For 1 month, shelter was at 2.1 or 2.2% on an annualized basis. But for the past month, July and August, we bounced back up and now above that plateau of 5%. My view is that June was the odd month. That was the problem. Because if you look at the end of the day, how do you set up the cost of a rent, right? You have like basically 3 items. One is the cost of the building. Now, what do we know about real estate prices? I mean, you look at your Case-Shiller, it's at an all-time high. In all the 20 cities that go in the Case-Shiller, you have gains of more than 2% for the past year. I think on average about 6-7%. So the price of the building is going up. Second bucket is how much does it cost to maintain the building? How much do you have to pay for maintenance, for electricity, for insurance, for garbage collection, things of that nature? That's going up. We're going back to the service story, right? The cost of the hairdresser basically is the same. The cost of the maintenance guy is going up by 5%. So the cost of maintaining the building is going up by 5%. The cost of the building itself is going up by 5%. Now, the third item is the margin, right? I mean, how much does the landlord take? Landlords typically are not charities, especially now that we have, private equity-owned real estate market. So I don't see how you can sustainably have shelter at even 3-4% with that. So if shelter, which is a 30% weight on the CPI, stays at 4-5%, and core services is reset to 4-5%, I mean, that's more than 50% of your CPI at that 4-5% level. Sure, you can be lucky, and to some extent, we are lucky, right? We have these very weak energy prices. We had this record oil production that's helping. We still have we import a lot of deflation from China. We had a strong dollar. So we had all these kind of temporary things that really took it down and gives the Fed indeed some space to maybe cut. But we have not solved the problem. So I would stay at obviously not hyperinflation, but a reset to an inflation rate of 4-5% seems, it's what has happened. We just don't see it yet.
A couple of important questions. That I want to ask you. And as I'm looking at this, stocks are bouncing around, and we expected this to happen because there was a lot of decision. They're up, but they sort of rallied a lot, and then they sort of came back and they rallied because they're trying to work through a lot of the tensions that Vincent's talking about. If it's positive for stocks, do you expect, or would history dictate that it goes to, once again, the risk assets, tech, mega cap tech? Is that the area, and does that happen once again at the expense of some value stocks?
Well, I mean,
or could we see rotation? Could it look different this time if it's equities?
I think we've tried way too hard to placate narratives on tech and the relation between tech and interest rate. It's a complex one. If you go by CFA textbook, discounted cash flow model, okay, if you earn a lot of your cash flows in the far future, which is not true for all tech, right? I mean, Meta, for example, gets a lot of cash flow today. It's not that clear that NVIDIA will be able to maintain this high growth rate, but generally it's thought that tech stocks like Amazon, most of the value of Amazon will be realized, 10 years and above, as opposed to, say, an old company that trades for 5 times cash flow. So theoretically, if you lower the discount rate, the value of these cash flows that are far out in the future is bigger today. So the long duration assets, which include tech stocks in theory, should do better when rates are lower. Now, the question is, which rates are we talking about, right? Because what the Fed cut is the overnight rate. Seems to me that if you look at the 10-year yield, the 10-year yield is kind of flattish on the day, right? So you have to look at the 10-year or the 30-year to make that calculation in proper term. The reason I put these caveats before I started this is because you could basically, we placated narratives. And another narrative that worked quite as well was, oh, these guys have a lot of cash, right? Apple famously sits on 200 billion cash. So when the Fed raises rates, they actually make money. I mean, Apple is a money market from these guys as the phone company. I think the reality is that, hey, big tech, large cap stocks have gone up like crazy for 5 years now. And then we've just tried to justify this with, oh, that's because of the interest rate channel, or that's because of the duration channel. But I'm not sure that the two are necessarily related. If anything, I would think that lower rates probably help more small caps, because most small caps have more debt. Some of that debt is more kind of short-term oriented. But the ability for them to refinance at a lower rate probably matters more than for an Apple, which is some 50-year debt, and that has more cash than they know what to do with. So they don't get, the business is not impacted by what the Fed did today.
Noelle Acheson, author of the Crypto is Macro newsletter, joined Speak Up with Antoni Scaramucci this week and described her Eureka moment and why she got into cryptocurrency. As an investor, she also explained the impact of interest rates today compared with 40 years ago. She and Antoni also spoke about how much influence politicians really have on the economy, fiscal, and monetary policies.
What was your Eureka moment?
You've met Hal Finney. I didn't know that. That is absolutely awesome. I mean, talk about an OG. I mean, you are now the OG because of that. My Eureka moment was that the technology...
No, I'm not, though. I want to interrupt you. I got into Bitcoin in 2020. I wasn't smart enough.
You were in the room. You were in the room in the early days.
I wish I had understood it better, but unfortunately, I was an old geezer, and I was institutionalized, and not just a mental institution. No, I'm talking about being an institutional investor. And so I missed one of the great transformational things that are happening this century. But go ahead.
It's really hard. I mean, and you and I talk probably every single day to traditional investors who will tell you it's never going to work, or it's just a risk asset. It's not. I mean, it's hard to get out of that. I'll give you a personal anecdote. I'm married to a traditional investment strategist, and it took me a year of dinner table debates to finally get the Satoshi to drop, as it were. And of course, now he's all in. When they were along the lines of, yeah, but what backs it? And yeah, but what backs the dollar? Anyway, went round and round, and that eventually came through. But you were asking what I saw in it. It was the technology. I didn't rest until I understood how the technology worked, because we've all heard so many times, and I'm sure you probably thought this when you were talking to Hal back in the day, decentralized, yeah, right, seen that before, know about the e-cash. It's centralized somewhere, right? Because pure decentralization is just not possible. And this is a humbling reminder that what we think today is just not possible may well be possible one day. And I studied the code, I made sure I understood how it worked, and I realized that, holy shit, yes, decentralization is actually possible with this way. We have a way for the network to pay itself. That was always the point of vulnerability before. And of course, permissionless payments, not really practical when people aren't familiar with technology in the first place. I mean, permissionless payments actually need rails to move on. People need to be familiar with the concept. And in many cash-heavy societies, especially in the global south, that's not really practical. So the more I researched this, the more I realized that permissionless payments, okay, there's a lot of barriers here. But what I was actually looking at, and this is where I got another set of goosebumps, was a new type of marketplace. And marketplaces, again, just the ability to spin up marketplaces pretty much anywhere in the world, that is in itself very powerful, because marketplaces are a force not just of redistribution, not just of price discovery, but in theory, markets should be a force for freedom. And we can agree that they've grown up gated, and therefore they're not really fulfilling their potential.
What would you say the impact is of interest rates today? Is it the same as it was 40 years ago? Are there other macro things that are happening in the marketplace? There's lots of technology that we have today, which is disinflationary. I know we've had a spasm of inflation here, but I think most people would agree that was related to the COVID-19 pandemic and some of the monetary and fiscal policy that got imposed globally. But what are your thoughts on where we are with inflation? What are your thoughts on interest rates? And how important is Federal Reserve movements one way or the other?
That is such a fascinating question, such a deep question, and such a good question to be asking now, because things are changing on pretty much all of those fronts. One of my favorite sayings, which is incredibly annoying to anyone who will listen to me, is everything's relative. And interest rates are the financial gravitas when there's just not a lot of other competing forces for attention and money. And now that we have discovered, Antoni, that deficits don't matter, and yes, I'm being somewhat ironic here, but yes, now that we have discovered that deficits don't matter, do interest rates still matter? We have now embarked on an easing cycle. And is this really going to provide the liquidity stimulus that the market seems to be expecting when the tightening cycle didn't tighten market liquidity at all? Financial conditions, according to the Chicago Fed, even before we entered the easing cycle, they were as loose as before the tightening cycle started. So we can argue that the monetary policy is not having the impact it might have once had, now that we have discovered that people actually don't really want to talk about the deficit anymore. Have you heard any of the candidates mention it?
Yeah. It's interesting. Yeah, no, I think, yeah, I no, I mean, I think this is one of the things. I mean, I'm going to get to the debt crisis in a second, but yes, no, I think we're in total agreement. And so that begs the question then, how do you feel about things like central bank digital currencies?
They're political. They are purely political, and not even domestically political. They are geopolitical in some instances. Obviously, the United States is not going to have a retail central bank digital currency because that's a political third rail. Europe will have a retail central bank digital currency, but no one's going to use it. China already has one, and they will do whatever it takes to make sure people use it. This is a very interesting example, actually. China has one. It's got several pilots. It's rolling them out. And it's had a big jump in transaction value as well, but we don't really know who's using this and why. China has been struggling to get adoption. It's tried paying public workers in the central bank digital currency. They immediately converted at the bank, so no one really wants to hold this. And if China can't get the use case going, then really who can? But it does become a geopolitical tool, and obviously China does have other goals perhaps in mind, I should say, that with the CBDC. Europe's goals in getting the retail CBDC off the ground, well, it just feels it needs to remain relevant. They actually have said this. The European central bank officials have said, yeah, we just need to remain relevant. And for the United States, obviously different equation whatsoever. India's struggling. Thailand has a sort of CBDC. It's not really one. It's wholesale CBDC. Now, that's the geopolitical tool. That is super interesting what's going on there. There are very few central banks that aren't experimenting with wholesale CBDCs and the connections that they can trigger. And especially at a time when the United States is increasingly weaponizing the dollar, there are many nation states that are scrambling to find an alternative.
Do politicians matter?
Love that question. Yes, they really, really do. They matter not just for economic expectations setting, and we've seen a lot of that in the US presidential campaign so far. They matter for your economics expectation setting. They also matter for just how much a population can be inspired to withstand discomfort in times of adjustment. I mean, a case in point is Argentina. I mean, to vote in a government that has said, I am slashing budgets and there will be a lot of pain, to vote them in, one says how bad things got, and God forbid that any of the economies that we live in should get that bad, but it says how bad things got, that they were voting for pain. But two, they did so because of the force of personality, because of the hope one particular politician delivered. And I'm not necessarily singing his praises here. There have been many unfortunate side effects of this, but still we can look at that as a case in point of why politicians do matter, because if not, people are going to continue to vote for convenience. They're going to to continue to vote for, yes, just give me more money. This worries me a lot about, and again, this is slightly off topic, but it does tie in slightly to what you brought in about the central bank digital currencies, and that's the idea of universal basic income that is starting to get some traction again in some circles. And again, who would not vote for free money? Yes, please give me more free money, but then how do you vote that party out?
It's an interesting thing, and I would say policy matters, right? And tax policy matters, right? They limited the state and local income tax deductions in the United States, and the blue states that have heavy safety nets. A lot of people said, "Oh, okay, well, I'm going to migrate to a lower tax state." We had 500,000 people leave New York. So politicians, they matter, right?
Do you think that tax is political, or is it also influenced by other factors?
It's a good question. I have to think about that. So, I'm gonna say that the big driver for me, and again, I could be wrong, and maybe this is me being a businessman and business centric, but the big driver for me is tax policy. I think tax policy is the central root of all policy, because people will move their behavior pursuant to taxes. And said differently, I live here in New York, so if I make $1, 52 cents goes to my government. That would include Kathy Hochul and Joe Biden. 48 cents goes to the Scaramucci family. So I'm a minority partner in my own life. My majority partner are the politicians as a result of tax policy. And so some of my friends have said, I don't really like that. I'd like to be a majority partner. And they've moved down to Florida where it's now 60-40. So
that's
so
a
to me, I
really
think
interesting
this,
way of looking at it. I hadn't thought of that. That's really interesting. But then the more people that do that, that also changes Florida's economics, which might in the end up impacting its tax policy.
oh, yeah, no, so they're going to turn Florida blue because people are going. It'll lead to more economic growth. It'll lead to more poor people. See, people forget this. Why do you have these high tax states in the port cities? We get a lot of poor people that show up at the port, and you need a safety net. And one of the big economic achievements for the United States is the great immigration story here. We have very poor people that can show up here. Sergey Brin, he's a refugee from Eastern Europe. He goes on to be worth $100+ billion, develops Google alongside of Larry Page. And we can name hundreds and hundreds of people, Andrew Carnegie, throughout the course of economic history in the United States that come penniless and go on to be quite rich. But in these port cities, they're blue for a reason. They are teeming with poor people. And sometimes poor people need a little lift or a little help to get to the starting block in the country's capitalism. And so I thought it was a mistake to reduce or limit that state and local income tax, because what people tend to forget is the economics. The port cities like New York, Boston, Philadelphia, San Francisco, et cetera, they're the economic engine for the country. Okay. And they percolate all of the economic activity and innovation throughout the country. I'm not saying you can't have economic innovation in the center of the country, but just study the country, and that's how it's by and large been. So, but hey, listen, what do I know? Tax to me is the central policy. You get the taxes right and you motivate people through the right incentives, you can create a lot of economic growth.
That is interesting. Do you think it's changed in the US? I'm asking you questions here, but I'm interested. Do you think it's changed in the US over the decades, the importance of tax policy?
Well, I think the way they tax has changed. I think it started out as that, we're going to tax you, and this is literally a bill for services. Your tax represents a bill for services. And now it's like we're going to tax you, and it may or may not be a bill for services, but it's going to be policy. It's going to be political policy. We're going to tax you in a way that's going to foment or create political policy. So if we don't want a big corporation like Amazon in Long Island City, well, then we'll make sure the taxes are such that they won't be able to arrive in Long Island City, even though that would have created an unbelievable amount of jobs in the city of New York. There was a group of progressives or socialists. They didn't want that big business here. They want the business to benefit from those tax breaks. And so they spited themselves by not allowing for that business. So listen, I mean, there's I don't know. I think it become very political with the tax policy. It's no longer a bill for services.
Thank you for watching this week's recap. If you need help navigating your financial situation, head over to wealthion.com/free for a free, no obligation financial review. And please follow us on social media. All the links are right below in the description. If you haven't done so already, please make sure to like and subscribe to our channel. And don't forget to hit the notification bell so you know when we post new videos to the channel. Thanks again for watching. If you like this content and are looking for more ways to keep growing your investments, watch this video next. Until next time, stay informed, be empowered, and may your investments flourish.